Hi, my name is Till and today I want to react on an interesting comment of the viewer Iosis85 that he gave me on my last video on the mental model 6 times double up and stop. Iosis85 wrote, "If step 1 seems out of reach, one could also start with the same logic to build up the needed capital to further grow the overall capital. One important aspect to this, you can get used to investing with amounts that don't scare people. Especially if you buy the dip, but the dip just turns out to be an intermediate dip, while the real one is another X% lower." Iosis85, I think in principle you're right. Yes, you can apply the investing logic also to smaller amounts of money. Especially if you're just starting out to invest and if your learning curve is still doing big leaps. It is of course much wiser to limit your risks. Losing $500 because you made a mistake is going to hurt you much less than losing $15,000. To contain risks and to tackle them with the proper tools is one of the most important tasks for every investor. Or to repeat the famous Buffett quote, "Rule number 1, don't lose money." But the 6 times double up and stop approach is not about containing risks. It is more an overarching philosophy that is supposed to provide you a different perspective. Basically, it is an answer to the problem of the 3 phases of the fortune development. This is explained in the video How to Build a Fortune with a Normal Job between minute 2012 and 2240 if you want to watch it again. In phase 1, the increase of your capital is mainly driven by the money that you can save. Problem is, the bigger returns on investment are not making a big impact on your wealth when the invested capital is relatively small. When you're doubling $500, you will earn 100% ROI, but it is still just $500 more. And although the triple down situations really happen from time to time, it can take a few years for this to work out. Sometimes less and sometimes more. And $500 are saved much faster than gained by investing. When you're one day having a fortune of $50,000 or $60,000, you will see that there is still an impact of saving more money. But it is not that significant anymore. Doubling it in a few years just by making use of the triple down situations is providing you with another $50,000 or $60,000. And this is then actually easier than making the $50,000 or $60,000 by saving the money. Let's put these thoughts real quick in a realistic and not too aggressive example. Since the year 2000, there were at least 4 major market crashes. In the year 2000 was the burst of the dot-com bubble. In the year 2002 and 2003, the second major dip of the dot-com bubble. 2008 and 2009 was the major financial market crisis, and in 2020 the Corona crash. When you look at the chart of a major stock index like the Nasdaq or the Dow Jones, you will see these 4 major dips immediately. This means on average every 5 years a major crash appeared that provided many triple down situations to double your money quite easily. Let's say you're using these situations to double an invested amount of money of just $500. 500, 1,000, 2,000, 4,000, 8,000 and 16,000. It takes circa 5 of these situations to achieve $15,000. When you're taking the 5 years average between the crash that we just assumed, we would achieve the $15,000 after around 25 years, just by trying to achieve them with investing. If you want to achieve them by saving money, and even if you're just saving $250 per month, you will have the $15,000 already after 5 years. If you're saving more per month, it will be even quicker. To summarize this quickly, every phase will have its own characteristics. The 6 times double up and stop model is meant to show you the big picture. As a beginner, focus on learning to invest and saving money. If you found this interesting, here's another video that might be interesting for you, and it would be really helpful if you leave a thumbs up. See you next time.